Risk management practice in banking today typically first of all identify the types of activity that give rise to risk in banking. Once risks are identified, they must be assessed and decisions made. In this context, there are a number of key risk terms. A good analogy when thinking about these risk terms is a water tank. The level of water or the risk exposure depends on the relative rates of flow of water or risk in and out. Risk exposure will rise, for example, if the value of the new business exceeds the value of business being run off, and vice versa. At any point in time, a bank's risk exposure represents the sum of the risk accepted at individual customer or counterparty and transaction level that have yet to be settled. But exposure is not a static measure because each risk decision results in new exposures, while existing exposures are constantly being settled, cancelled, or written off. The full capacity of the water tank is our risk capacity, which is the ability of a bank to absorb losses. The maximum water level can be seen as our risk appetite, which is the level of risk that a bank is willing to accept. Risk appetite should always be set lower than risk capacity to ensure there is adequate room to absorb the impact of unexpected losses. What about risk tolerance, which is the willingness of a bank to accept a breach of risk appetite? Risk tolerance is often set higher than risk appetite, though it may be set at the same level if, for example, there is no tolerance for such breaches. And finally, let's come back to risk exposure, which is the level of risk that bank is currently exposed to. Risk exposure changes over time, so at any point it may be below risk appetite or above risk appetite. If risk exposure exceeds risk appetite or risk tolerance, management should take action to manage it down, unless this is expected to happen in the near future. Note that risk appetite should not be adjusted upwards to accommodate a higher level of risk exposure, unless risk capacity has also increased. It is also important to look at the quantity and quality of risk exposure. If, for example, a bank accepts a high quantity or volume of risk, it will be like the water inflow is bigger and faster. If the risk out or water outflow remains the same, then the risk exposure or water level will increase. Similarly, if the bank accepts more risky business and or the quality of risk controls is weak, so the water outflow is slow, then the risk exposure will also go up. When reporting risk exposure, it is useful to include both gross and net values. Gross exposure is the amount at risk, where net exposure is gross exposure less the value of mitigation. Net exposure provides a better indicator of likely losses, but gross exposure should not be overlooked due to the risk of mitigation failure. Thanks for watching. We'll be looking at risk profile in the next session.